Hello, this is Justin from Auto Trading Academy. So in this video we're going to look at whether your Forex broker is a true ECN broker or if it's a hybrid, so it could be an STP ECN broker and a dealing desk at the same time. And essentially this determines whether your Forex broker is trading with you or against you. So to really sort of understand this question, we need to look at basically the details of how these Forex brokers work. But 95% of them are actually this model, which is basically a hybrid between a dealing desk and a non-dealing desk broker. And the way it works is that basically when the Forex market started back in 2005 with MetaTrader 4, the dealing desk broker model was basically born because MetaTrader 4 was designed basically to be a dealing desk, which is essentially sort of a casino model that creates a market for you by taking on risk. So that's basically how it works. And there was basically the rise of the dealing desk brokers, and then we shifted on into ECN, STP, basically models, and now basically we have actually most brokers are a hybrid. There are very few brokers that are pure, STP, ECN brokers. Most of them actually have a sort of hybrid model, and you sort of get the best of both worlds, from a business perspective. So you do actually need to understand how all of this works to really figure out and sort of check in the way of what's sort of best for you. But essentially, if we go into the details, what happens with a dealing desk broker is basically when you place a trade through your platform, so let's say that's MT4, what happens is basically, your trade goes straight to a dealing desk. So if you go long euro dollar, so it goes to the server of the dealing desks. One of the reasons why the execution is really fast, almost instant. And basically they place the opposite trade against you by taking on the market risk. So basically they take on risk and they place the opposite trade against you. So they go short euro dollar, and your trade never actually reaches the interbank market. So what the dealing desk does is it basically gets a feed from the interbank market, and they create their own price feed as a result, and basically create that market for you. So they're basically creating their own price feeds. So they're two different feeds in a way, and they can differ quite a lot. And so they're creating their own market conditions for you, with whatever leverage and spread and so on, and basically providing that sort of trading conditions. Now, essentially, in that way, the dealing desk market model is basically a casino. They're always trading against you by taking on risk and essentially creating that market for you in that way. So, not a very nice model, because all of your, from a incentives perspective, because all of your losses are their profits, and in that way, the dealing desk is never really interested for you to make long-term profit, because your profit is their loss. What they're really interested in for you is to basically do lots of trades, never really make any money, and trade for relatively longer period trades rather than go out there to scalp, because in that way essentially they're making money from the spread that they're charging you, which is basically the difference that of the fee that they're creating you from the interbank market and the feed that you're getting. So they're making money on all the trades and on the spread basically, and also they're making money if you lose. So they're not really interested for you to gain. So the ideal business is if you make a lot of trades, don't scalp, and don't make money, and then if you lose, it's also good for them because they make money in that way. So as basically their customer base grows and their business grows, there are more and more traders, and essentially the market is made almost naturally, because some traders might go long and some traders might go short, and they basically market make for each other in a way, in a sort of internal market, and basically you're pocketing the spread, which is good for you. So it's ideal for them to grow that base as big as they can, because it's basically a printing money machine. You're basically pocketing the spread. So if you're getting a lot of traders that are trading big amounts, big lot sizes, or if you're getting traders that are trading basically scalping all the time, it's not so good for you, because it's hard to manage that risk that you're taking on. You know, and with very big traders trading big lot sizes, they could essentially blow your casino house, and effectively you could go bankrupt. So that's the sort of model, basically just like a casino. If a guy is always winning, you know, they're not really interested for you to stay in that casino, because you're taking away all their money. Now, this sort of model obviously became under a lot of pressure and got a lot of bad press and a lot of criticism, because essentially, you know, your interests are not aligned with the brokers. And you know, even though there is a lot of bad press, there are obviously good points to it. And the main sort of good point here is that basically, you know, we wouldn't exist here if the dealing desk didn't exist. And the only reason they came about is because of technology, and the only reason the STP sort of side over here came about is because of technology as well. So really you can look at it as a sort of technological advancement, to be able to actually trade with the real market. So in here your trades never actually reach the market, they're just basically being you're basically just trading with the desk. Well, you're not even really trading, because your trades aren't going to the market, they're just, you're making bilateral agreements with the dealing desk, and that's how the market's created you, and you know, they take on the risk. So essentially, you know, that's good, because you know, if the market is illiquid, then they can create their market for you to trade in good conditions, you know, by taking on risk. So they could give you, you know, they could, you know, allow you to trade a certain instrument at much lower spreads, when it's not actually that, you know, very possible to do. And they could also provide you access to instruments that are very, very liquid to trade, and you know, make those conditions for you essentially to trade that instrument, when otherwise it wouldn't be possible. So there are sort of their benefits in a way, and you know, there are other benefits as well in times of uncertainty, or if certain currency pairs, let's say, are very, you know, fluctuating and have, you know, very unpredictable spreads, then they can offer, you know, fixed spread accounts, to sort of mitigate that risk for you, and basically that's pretty good as well. So usually, you know, fixed spread accounts is a good sign that it's a dealing desk account type, and you know, you're basically just trading with a dealing desk. So I know actually a guy who exploits this in stupid dealing desk brokers by trading very big lot amounts, you know, 20-30 lots on news breakout times for a very short period. I think it's about 15, you know, 30 seconds just as the market's open, and he basically uses pending orders either way, and effectively, you know, the spreads during those times in the real market are actually much higher, 3 or 4 or 5 or even 10 times higher, whereas, you know, you're getting a nice fixed spread from your dealer with very good execution, which you wouldn't really get in the real market. And that way you can, you know, pocket a few pips very quickly with very big lot size and leverage, and make a lot of very good money. And the broker, well, basically I wouldn't even call them brokers, they're, you know, dealing desks, you know, lose a lot of money. So he actually got banned in most of the brokers he went to, and he just keeps on switching brokers, and he's basically found a lot of stuff out on basically how the dealing desks can play a lot of tricks on you to make you lose, and he certainly had a lot of tricks played on him, you know, delays in his orders, basically lots of things that the brokers were doing to him to prevent him to make that money on those news periods. So what actually a lot of brokers have now moved into is, when they do offer the fixed spread accounts, they specifically state that they don't allow you to trade and scalp during newsfeed times. So they just basically now have put the conditions in there, because obviously a lot of people have taken advantage of that. So there are sort of advantages there in the way, and you know, you get also very good execution, because your trades actually aren't even going to the real market, they're just going to the dealing desk server and back to you, whereas when you're trading with the real market, the STP ECN model, that's basically going to the real market. Now effectively what's happening is, when you're trading the STP non-dealing desk model, is is basically this side is not taking any risk. It's basically passing your trades straight through the market by acting as an agent. So if you imagine, this is the MT4 platform, and this is the, let's say this is the broker, which you can actually call it a broker now because it is actually brokering your trades, whereas a dealing desk isn't really brokering anything for you. So what's really happening is basically it goes, if you go long, it goes short, but it also goes long at the same time in the market, which basically translates into you going long into the market. So it basically acts as a pure intermediary, doesn't take any market risk on, and is basically pocketing money from the commissions or the marked up spreads from the raw spread that you're actually getting from the real market. So because of that, your execution time is usually slower because you actually have to travel the real distance to the real market. So you got to travel from into the server, into your broker server, and from the broker to the market, and back and so on. So basically there is a much longer execution sort of pathway, and that's what the real market is. So your spreads also can vary a lot more, and especially during news and when the times are much less illiquid, you're going to get much higher spreads than you would get, let's say, in a dealing desk, because that's the real market. And effectively, your STP ECN broker is basically just acting as an agent for you, and it's got your interests at heart in a way, because they want you to keep you as a customer, and they're interested for you to win so that you stay with them, so that they can make more and more money from you from the commissions. And basically the way here that ECN and STP differs is that ECNs usually charge a commission and give you a raw spread, the sort of true ECNs, whereas STP's DMA sort of models, they usually use a spread markup and they don't charge you commission. But there are all sorts of mixes. There are STPs that charge commission and have a spread markup, or same with ECNs as well. So it depends, but essentially they're very similar models, and basically your trades go straight into the interbank market, where lots of hedge funds, banks, and financial institutions are participating for you as liquidity providers to give you the best possible price, and so on. Now obviously STPs essentially are in sort of two models. One is DMA, which is direct market access model, and another one is ECN. So ECN is basically lots of these participants, liquidity providers, going into an aggregation engine, and then you're getting sort of the price from there. Whereas with direct market access model, what's really happening is you're connecting to an exchange basically, and as you know, Forex market doesn't have a centralized exchange, and that's basically what's happening in ECN network. You're just connecting to that network, whereas in DMA model, direct market access STP model, you're basically connecting straight to the exchange, for example LMAX, where lots of banks participate, and you're getting a single price feed into your trading platform, and basically that's how you trade. So essentially, there's a lot of bad there, and with the dealing desks, and a lot of good in a way with the real market. Everything has its pros and cons, and most Forex brokers operate both models, and the way they do that is basically they stuff you in from one side to the other depending on what happens. So if you're a loser, then obviously that's good for them. They keep you in the dealing desk model, and then if you start winning, they basically shift you to the real market. So that's called basically B booking, and basically if you're a loser, you're in the B book, and if you're a winner, you go to the A book, which is basically a very sound business model for them, because if you lose, they make money, and if you win, they don't want to take on that risk and have you eating away their profits, so they just stick you to the real market and pocket your spread, which is also good for them. So they have lots of different tools how they monitor this, portfolio level, risk management, and so on, and effectively that's how they work. So most actual brokers do this, and they have lots of different account types, so it's actually really hard to understand what the hell's going on with each broker, and if your broker is true ECN or if it's a hybrid. But most likely it's a hybrid, and sometimes they make it quite clear, sometimes they don't, whether it's an ECN account, it's a true ECN account that goes to straight to the market, or if it's a dealing desk account, and so on. So what are the sort of big bad things about the dealing desk option? Well, as we said, to sum it up, well, the incentives are not in your interest. You're basically trading with a casino. Eventually the casino could break at some point if there are some big guys with big money, making big wins. So the house could break and everyone loses their money. Someone effectively, if it's a dishonest house, someone could notice your strategy and basically front run it with bigger trades with their own money. And essentially, if you're making consistent profits with your EA, for example, on a small account, they could notice that after a year, for example, and suddenly decide to put their own money in it and front run your trades. So that's quite a bad thing, and potentially can happen. Whereas in ECN type sort of network, it's not really possible to sort of do that. In the dealing desk, they basically see everything. They see your stop losses. They see they basically see everything that you're doing with the trade, because they're taking the other side of the trade. And because of that, there's a lot of incentives for them to be dishonest, and a lot of brokers have been dishonest, and there's lots of tricks they can play, by giving you delayed order prices, like one of my friends was getting with the news trading with the fixed spread accounts. So that he started suddenly getting 20, sometimes like 20 milliseconds, and then it started going to not 20 milliseconds, sort of 2 seconds, and then he started getting 3 or 4 or 5 second delays from every trade he was placing, and this is definitely not normal. And there's all sorts of things they can do. They can requotes, a classic requotes of your prices, triggering your stop losses, increasing the spreads, changing their leverage, for example, on the weekends, to liquidate the guys that are already in big minuses, but they haven't stopped out yet. And when they change the leverage, for example, make it smaller, then the big losses stop out, and you make very nice profits from their losses. So yeah, basically Forex.com, Gain Capital did this, I think in 2009, and they got some big fines. There's also slippage, where you can basically get charged for slippage, but you don't really get charged for positive slippage. So FXCM was fined for this. In reality, there is no such thing as slippage in the dealing desk, because well, there is sort of, but in reality, it's they can manipulate that very easily. So all of these tricks can be played with a nice tool called MT4 Virtual Dealer plugin. And if you just Google that and have a look what you're able to do with that as a dealer, you'll see just what sort of things your broker can get up to. So you can read about all of these cases on the internet of how basically each broker has been fined for what, and they're usually regulated, they're regulated big brokers. So there is a lot of bad there, and a lot of incentives to do dishonest tricks on you. So basically, is your broker trading against you or with you? Well, usually it's a bit of both if you're in a hybrid model, and it really depends how well you choose your broker. And the best actually is to choose obviously ECN brokers. But even some of the ECN brokers, what they do is they operate a sort of interesting model where they have some very good friends as liquidity providers over here, and they have nice revenue sharing agreements where basically they pass all the order flow information from you, basically sell the information out of all your info to, let's say, that other liquidity provider or bank or basically friend liquidity provider, who's essentially will kick back you from the losses that you are making, because most of the traders lose money anyway. So if it's a pure ECN broker and you think it's pure ECN, well, think again. It could be It could be that, basically what they've done is that they just said that they're pure ECN because now they are, but in reality, one of their great partners, in that ECN network is taking, the other side of your trades and is, making all the money from your losses and kicking back basically cash to your, true ECN broker, as you might call it. So there are all sorts of dishonest sort of conflicts of interest there, that can happen. So one of the ways to sort of avoid this is to basically trade with a pure DMA ECN broker. That's sort of the only way that I can think of, and that what that basically means is trading with a broker that is basically the second type, as I said, direct market access, is the one that's connecting straight to an exchange. That way you're prevented from all of these cheeky partnerships with other liquidity providers, because when you're connected straight to an exchange, for example LMAX, you're just getting a single price as a result of all the participants in that exchange, and it's going to be pretty hard to strike deals there, because the exchange is regulated, and yeah, basically it's basically a central forex facility exchange which is only been developed, and all of these exchanges are developing relatively recently, and it's a much better, more sort of fair battle, because in the market you're also basically trading against someone all the time. Here you're trading against dealing desk, here you're basically trading against all the other liquidity providers. But obviously if you want to make sure that battle is fair, so there's nothing sort of wrong with trading against each other. All you want to do is make sure the battle is fair, and they don't know the information that you're basically placing in your trades, whether it's your stop losses or something else. So one of the ways to avoid this is basically trade with a DMA, direct access broker, STP DMA broker essentially, and the one that connects to an exchange, because it's pretty much impossible then to do any of that. So how do you find all of these other brokers? Well, it is possible. Basically just try and find websites that clearly show that your broker is DMA STP, and you can find that. Obviously the STP DMA brokers can be connected to maybe 2 or 3 exchanges, for example, so that that's possible as well. So if we actually go to this website here, I think I found one. There's actually loads of them, and you can check things out. And essentially, if you go down here, you'll see that they have actually singled out DMA STP brokers here, and even show the the commissions and sort of basically the commissions and interbank spreads and minimum deposits here as well. So Pepperstone Raisin account, Hot Forex, the CarNext account, so FX Open L2, IG Market. So it's, that's now a lot more clear. For example, also what you can do is make sure you choose basically a regulated broker, and essentially what that means is basically choose a broker that's got good regulation, for example in the UK, and you can always check their licensing and what they have. And if you just go to, for example, I'll search here FX Open, there's lots of reasons basically to choose a regulated broker, so I'll go through them in a minute very quickly. But effectively, if you go here, you can check their licensing, regulation, and so on. And the way to check if they are pure STP ECN, again, is to basically see if they have these things here. So if they have the arranging and safeguarding of administration of assets, that basically means they are able to handle customer client money, so which is like a must for a broker. If they have the dealings and investment as agent, that basically means they're pure STP broker. And if they have dealing in investments as principal, that they have the rights basically and permissions to be a dealing desk. So basically what you want to see is just this, or there is another ways, but actually a lot of brokers have both permissions. And actually you see this one has got a limited license, so this is absolutely crucial, which basically means, you know, matched principal broker, where you're basically acting as an agent, so you can't essentially take on risk on your client's orders. Basically that's what it means. So it's the same as STP, so you can have the dealings in investment as principal as well as the agent, but make sure there is the limitation there to basically take the opposite side of the trades, which basically means it's the same as STP. So you can check these things out. Obviously, if it's a UK regulated broker, I'm not sure how you find this out for other regulated brokers in the world, but you know, that's how you do it for UK. And obviously UK regulation is one of the best in the world, plus your deposits as a result are basically secured for up to £50,000 if the broker does go bust. So it's one of the best, you know, deposit sort of guarantees in investments in the world. It's very, very, very good. So, you know, basically choose a broker that's regulated, and you can check these things out with STP ECN on the regulation website. So this is basically in the Financial Services Register. And yeah, basically that's it. And then also you can use a lot of other websites, obviously, to find out which you know, brokers are pure STP ECN, because some brokers, you know, can be both, can be dealing desks and STP ECN brokers, but obviously have a different accounts for different types of, you know, feeds, basically, that you're getting different types of markets that they're creating for you or acting as agents. So here's a good example with, you know, Pepperstone Razor, Hot Forex, Carnex, and FX Open as well. So that's basically how this all works. I hope you guys sort of enjoyed this video, and you know, you understand that actually most Forex brokers are both, and you really have to be quite picky to choose the right sort of account when you're trading. You know, especially if you're doing, you know, automated trading with EAs, and you want your intellectual property to be nicely protected, and so on. So I hope you guys like this video, and I'll see you in another one.